Hello, my dear students. Welcome you all. Now, today we are going to start a new chapter in our corporate accounting. The name of the chapter is cash flow statement. So, which is very, very important examination point of view. See, in this chapter, what we are going to learn is how cash flow statement will be prepared along with accounting standard 3. See, there is a separate standard called accounting standard 3 which exclusively deals with cash flow statement. So that standard also we need to cover in this chapter. So I have prepared a notes relating to the cash flow statement. See here, the entire chapter of cash flow statement is been divided into two parts. The first part is the basic part, basic concepts we need to understand, and the second part is about preparation of cash flow statement. See, the first part, if you see, what is cash flow statement and what are the benefits or advantages of cash flow statement, why we are preparing cash flow statement basically, and then is cash flow statement is necessary for all kinds of enterprises, so applicability, and also what are the important terms which is used in cash flow statement. See, in this cash flow statement there are certain terms which is very, very important, so we need to understand the meaning of those terms. So this is the first set of discussion we need to make. Once we learn the basic concepts relating to cash flow statement, then we go for preparation of cash flow statement. See, for preparation of cash flow statement, there are two methods, direct method, indirect method. So under both the methods, how cash flow statement will be prepared, we need to discuss. Now see, before proceeding to, see, this is the order I am going to discuss. Before proceeding to the main topics, first of all, understand, as far as the Companies Act is concerned, we know Section 2, Clause 40 of the Companies Act defines financial statements. So, financial statements of a company includes what? Generally, P&L account, balance sheet, and cash flow statement. See here, cash flow statement is part of financial statements. But we have learned previously one chapter called preparation of financial statements of an entity. There I said we are going to cover cash flow statement as a separate chapter. Generally, cash flow statement is part of financial statements only. We have to learn along with financial statements like balance sheet, P&L. Cash flow statement is also part of this, one of the component of financial statements. But we are discussing this as a separate chapter. So cash flow statement as a separate chapter. So first point, so what the point we need to remember is cash flow statement is part of financial statements. So cash flow statement is a component of financial statements. So it is component of a financial statement. One of the component of a financial statements. Now let us start discussing the topics in the order which is given. Now, first of all, what is cash flow statement? See, let me give you brief idea about this chapter, sir. Sir, cash is one of the important resource for any kind of organization. Agreed or not? Yes, definitely. You should agree. Cash is one of the important component of any organization. Now, whether is it required to have a proper analysis of this cash? Because as an organization on daily basis we are doing so many transactions involving cash. So whether proper analysis is required or not to take some decisions. For example, in a particular financial year, how much cash we are generating, how much cash is required to meet our expenses. Suppose in future, if company wants company planning something to purchase any fixed asset, how much cash it able to generate and how much cash it requires further. See, and what is the quality of our generation of cash, whether we are generating cash through our main business or we are generating cash through any other activities which is not directly related to our operations. See, all these things, how will you know? How can you take decisions? How can you plan? How can you prepare cash budgets? So, therefore, definitely you should have a proper analysis of cash. Now, every business enterprises have to prepare this cash flow statement so that they will get an overall idea about so how much cash we are generating under, I mean, which category, how much cash we are generating, whether we are generating sufficient cash or not, and in order to improve our cash, so cash flows, what we need to do. So all these decisions we can take. Since cash is an important element, so proper analysis of the cash is required for any business organization. That's why our ICAs came up, the Institute of Chartered Accountants of India is came up with one standard called Accounting Standard 3. Now in this standard they will prescribe how this cash flow statement will be prepared, now how cash will be properly classified, and how the statement will be prepared. All those things they will so prescribed in this standard. Okay, so first of all, what is cash flow statement? See, cash flow statement is a statement showing inflows and outflows of cash and cash equivalents of in a particular financial year. In a particular financial year, the inflows and the outflows of cash and cash equivalents. So that flow, that inflows and outflows, see here, cash flow, flow means either inflow or outflow. So cash flow statement is a statement showing inflows and outflows of cash and cash equivalents during a particular financial year. So during a particular financial year, what will be our inflows? What will be our outflows? So that will be shown. That will be shown. So that is called cash flow statement. So what is cash flow statements here? A cash flow statement shows a company's inflows and outflows of cash during a particular accounting period. Inflows and outflows of cash as well as cash equivalents. See here, not only cash, they use the word cash equivalents. So during a particular financial year, what will be my inflows of cash? What will be my outflows of cash? That I will prepare in the form of a statement. That statement they call it as cash flow statement. Now see, according to AS3, the entire cash activities they have divided into three categories. One is operating activities, another one is investing activities, another one is financing activities. See, important. As per Accounting Standard 3, the item involving cash, see, cash must involve cash and cash equivalents. Either there may be inflow or there may be outflow. So the cash activities they have divided into three categories. So they call it as operating activities, investing activities, financing activities. Like that, AS3 has classified the cash activities into three categories. Now this cash flow statement shows the impact of operating, financing, investing activities on cash. On cash, what will be the impact of operating activities? What will be the impact of financing activities? What will be the impact of investing activities? Now, basically, cash flow statement provides relevant information in assessing the company's liquidity, quality of earnings, and solvency. See, I told you whether company is generating sufficient cash to meet expenditure. For example, every month company need to pay salaries. So every month company need to pay rental expenditure, electricity expenditure. Every month company need to company need to purchase raw material for production. So lot of expenditure company need to incur na, for that cash required. Whether company is generating sufficient cash, is companies having liquidity? What about quality of earnings? How we are earning? For example, I will tell you. See why cash flow statement. For example, uh, cash and cash equivalents on 1/4/2024, for example 20 lakhs. Now cash and cash equivalents on 31st March 2025, suppose rupees 50 lakhs. Tell me, opening cash and cash equivalents 20 lakhs, closing cash and cash equivalents 50 lakhs. Now, by looking at this, what is your opinion about company's cash position? Obviously, you think that the position is good because the cash balance has increased from 20 to 50 lakhs. What about, suppose if I given information how this 20 has become 50? Suppose a company has taken a bank loan they have taken of 30 lakhs. Now, because of that, our balance has become 50 lakhs. Now, see, this 30 lakhs is because of bank loan, not because of our sales, not because of our earnings. So, what is the quality of your earnings? Suppose the company is always depending upon borrowings, always getting money from outside through borrowings. So, I mean, the how long company can survive if the earnings are not quality earnings, if the cash they are generating is not from the main operations. So this cash flow statement will help you to identify that how much cash we are generating from operating activities, how much cash we are generating from investing activities, financing activities. That's why this standard has classified the cash activities into three categories. I told you, operating activities, investing activities, financing activities. So what is cash flow statement? If somebody asks you what is cash flow statement, you have to tell simple. In a business organization, lot of cash transactions will be done every year. Now inflows will be done, outflows will be done. These cash activities we will divide into three categories. One is operating activities, another one is investing activities, another one is financing activities. Now after grouping into these three categories, they will be presented in the form of one statement. That statement is cash flow statement. Now this cash flow statement is like a financial tool, will help us to analyze the cash properly and to take proper decisions relating to cash of the organization. Sir, we are preparing what is it, cash book? We are preparing cash book now, sir. Again, why we need to prepare cash flow statement? See, we prepare cash book, but cash book will not give you any analytical information. That will shows only what receipts and what are the receipts, what are the payments. Of course, inflows, outflows. Receipt means inflow, payment means outflows. It shows inflows and outflows, but out of these inflows and outflows, receipts and payments, these inflows and outflows belongs to which activity? Is it operating, is it financing, is it investing? That analysis is not given by accounting, cash book. That analysis will be given only by cash flow statement. That's why we can say that the cash flow statement is far more superior financial tool than cash book, normal cash book. That's why we thought of having a separate standard to prepare this cash flow statement. Of course, this cash flow statement is only for big enterprises, listed enterprises, not for small entities, because for small entities, analysis of the cash can be done through this cash book and all. So no need to prepare, no need to group the items into different categories and follow accounting standard 3 to prepare cash flow statement. We will see in applicability. So this is cash flow statement. Sir, what is the benefit, sir? When you prepare cash flow statement, what is the benefit? See, a lot of benefits are there. I already told some benefits. First of all, it provides information about the changes in cash and cash equivalents during a particular period. Changes. Sir, what is cash equivalent? I will tell you. Wait. Remember, as of now, assume that it is also a cash. For example, I have a cash, physical cash. I have bank balance. I have checks. I have DD. I have some other kind of money instruments which is carrying money value. So those are all cash and cash equivalents only. Okay. First of all, by seeing cash flow statement, what we know is what are the changes happened in the cash and cash equivalents during a particular year. What is my opening cash and cash equivalents? What is my closing cash and cash equivalents? During there, how much change happened? How much is the inflows and how much is the outflows? Ultimately, what is the net? Whether it is inflow now, outflow now. Whether my inflows is more than outflows or outflows is more than inflows. That means my receipt is more than payments. Payments is more than receipt. So that we will know. That is the first benefit of preparing cash flow statement. Second, it provides information about enterprise liquidity, flexibility, ability to generate future cash flows. Sir, Reliance company, how much it has the ability to generate future cash flows? How much cash it is generating every year? Tata company, how much cash it is generating every year? Whether it is generating sufficient cash to meet its liquidity. For example, Reliance company expenditure per annum is, for example, 50,000 crores. but they are generating a cash of 40,000 crores only. So therefore 10,000 crores of cash, there is a shortage. Now how they are going to meet this shortage? They will, improve their future generating, cash generating ability. So therefore how they can take a decision? Only by making analysis. For that this will help. So which is critically important to survival and successful growth. Definitely for survival and successful growth of any organization, they should have the ability to generate sufficient cash flows, and they should be proper liquidity, sufficient liquidity to meet the expenditure, all these things. So by preparing cash flow statement, all these things we can achieve. And it is also helps to determine the future requirement of cash and cash equivalents. This point also I covered. For example, Reliance company is planning in the next coming 5 years, they want to, to every village, every place in India, they want to spread 5G spectrum. So for that they need so much money, right? Now for that they need to make a plan, how much money we want in the next 5 years. So how, on what basis they will make budgets, on what basis they will make estimation? First of all, they should know how much cash they are able to generate now, how much cash they are having already, how much cash they need to spend every year, and what is the ability to generate cash every year. So depending upon that, they will estimate how much cash they require in the next coming 5 years, and based on that they will procure the sources. So it helps to determine the future requirements. So cash flow statement will help you to identify your future requirements of cash and cash equivalents. And also it can provide information about entity's ability to meet its obligations as they become due. So whether company is able to generate its liabilities in future. So based on cash flow statement you can tell. You take cash flow statement of last 3 or 4 years, make analysis, then you will know how much cash they are generating from operating activities and how much they need to spend for financing investing activities. So what is their generating ability, so whether they will meet their future liabilities or not, all these things we know. And it helps to compare operational efficiency of different enterprises. There are different enterprises. For example, Tata company, Tata Motors can compare with Wipro company, Wipro can compare with Infosys compare with TCS. All these companies, they can compare with one another and compare their operational efficiency, whether with the set of same amount of resources, how much cash this company is generating, how much cash this company is generating, how efficiently they are operating their business. So we can know by looking at the cash flow statement. So if the cash flows are good, if the company is generating sufficient cash than other entity with the same set of resources, same type of resources, then this company operational efficiency is far good. So we can compare cash flow statement of different enterprises, and we came to know about the operational efficiency, so that we can know where we are lacking and we can make plans to improve. So these are the benefits of cash flow statement. No need to remember anything, just to get the overall idea, completeness of understanding, I'm explaining this benefits of cash flow statement. So we discussed what is cash flow statement. Cash flow statement is nothing but a statement showing inflows and outflows of cash. But as per accounting standard 3, these cash activities are divided into 3 types: operating, financing, investing. Okay. Now that is the edge when compared with the normal cash book, what we are preparing. Now applicability. Sir, is it cash flow statement is mandatory for everybody? I told you no, not mandatory. It is mandatory only for big enterprises, not for small and medium sized enterprises. So CFS is mandatory only for level 1 entities. Level 1 entities means listed companies. Actually, we are going to discuss accounting standards. In that accounting standard, there is a classification. Level 1 entities, level 2 entities, level 3 entities, level 4 entities. Like that, there is a classification. Now, depending upon the type, class of enterprises, accounting standards exemption is given. Now, level 1 entity means it's a big enterprise, listed enterprise, a company, listed company. Definitely all standards are applicable. So, non-SMCs other than small and medium size enterprise. So, CFS is mandatory for level 1. Suppose in examination, sometimes you will give you non-SMCs. Non-SMCs, level 1, both are same only. Don't get confused. But there is an exception list. See, this standard is not mandatory for the following enterprises. The following entities are exempted from CFS. That means not mandatory. Of course, if they want to follow, they can follow. Nobody is going to stop them. Sir, we want to follow accounting standard 3. We want to prepare cash flow statement. You can. Of course, if it is, even though it is not mandatory to you, if you want to follow, you can follow. But nobody is going to question you. And why unnecessarily you need to create burden? So when you don't want to create, when you don't want to prepare cash flow statement, it is not mandatory as per the act. So not required to prepare. But of course, if you feel cash flow statement will help you as a financial tool to take better decisions, then definitely you can prepare cash flow statement. But for the following enterprises, this is not mandatory. First, small company. So small company, so turnover wise very less company, they are not required to mandatorily prepare cash flow statement, because there is nothing much to analyze about their cash and cash equivalents. So they have given exception to these companies. And of course, OPC, one person company. So one person company again is also it is not a large enterprise, listed large enterprise, so it's a small business only. So a dormant company, inactive company, and especially a startup private company. So a private company which is newly started, so startup private company. So these are the four entities. CFS is not mandatory, but if they want to prepare, they can prepare. This is applicability of accounting standard 3. Now the most important part is understanding certain terms. Sir, from the beginning of the chapter, I am using the word cash and cash equivalents, cash and cash equivalents, cash and cash equivalents, and the chapter name itself is what? Cash flow statement. Now, first of all, what is cash? They say cash include cash in hand. Cash in hand means it includes bank balance also. So no need to say cash in hand, cash at bank. Cash in hand means even our bank balance is also cash in hand. It may be in the form of coins, money orders, checks, demand draft, everything is cash only. And most important thing is cash include cash in hand, demand deposits with bank, DD, demand deposits. Demand draft, no, that is different. DD, that is different. Demand draft. This is demand deposits with bank. So what is this demand deposits with bank? See, demand deposit means any deposit in the bank which we can withdraw any point of time without any restriction or without paying any penalty, which we can withdraw any point of time. That is called demand deposit. So demand deposit, amount which can be withdrawn at any point of time. See, any point of time, any point of time without any restrictions or penalty. So any point of time. So any point of time. If you want to withdraw, you can withdraw. Nobody is going to give question you, and you are not required to give any proper notice, prior notice also. That means the amount in our savings account, current account, if I want, I can withdraw any point of time. That is called demand deposits. And the most important thing is even these demand deposits are also part of cash. So they are going to ask you MCQ. So cash includes cash in hand and demand deposits. Demand deposits means any amount in the bank which can be withdrawn any point of time without any prior notice, without any restriction. Okay, so we understood what is cash. Now the most important thing is cash and cash equivalents. Sir, what is cash equivalents? See, in this standard, cash and cash equivalents, technically we will include, we will see. But there is a difference between cash and cash equivalents. Just now we saw cash means whatever the cash in hand, whatever the demand deposits. What is cash equivalents? This is very important, because later on when you classify the cash activities into operating, investing, financing, especially investing activity, if you want to classify anything, so there this cash equivalents will help you. First of all, what is cash equivalents? See, listen. Cash equivalents are investments, nothing but. Investment means what? Our resources, our money, we will invest in securities. Maybe our company purchases shares of another company. Our company purchases government deposits, government bonds. Our company may purchase debt securities. Like that, our money we will put somewhere else. So that is called investment. So cash equivalents are also investments. But which investment? Ultra, very short term investment. That means 3 months or less. But main character is they should be highly liquid. These investments should be made in highly liquid and they can convert into cash any point of time, and the principal should not be in danger. That means the risk should be minimum. There should not be any significant risk of change in value. Suppose if there is any significant risk of change in value, then that investment will not fit into the definition of cash equivalent. So understand what is cash equivalent? Simple. Investment. Which investment? Ultra short term. That means 3 months or less. And this investment is highly liquid. It should be highly liquid and principal should not be in danger. Then that kind of investment is called a cash equivalent. And that means cash equivalent means it should be considered at par with cash. That's why the standard uses the word cash and cash equivalents. Whether cash equivalents are considered as investments in investing activity, answer is no. Once an investment is fitting into the definition of cash equivalent, later it cannot be classified as investing activity. Okay. So what is cash equivalent? See here given short term. First thing is short term. Short term means 3 months or less. So 3 months or less. 3 months or less. So investment made for 3 months or less. Highly liquid. See here. Highly liquid investments. Highly liquid. Highly liquid means that can be converted into cash any point of time. Readily convertible into cash. That can be readily convertible into cash. And which are subject to an insignificant risk of change in value. This is most important. Insignificant risk. Significant risk or insignificant risk? Insignificant risk of change in value. That means the value should not be subject to significant risk. So the value should not be subject to significant risk of change in value. Suppose if it is a significant risk of change in value, don't consider this as cash equivalent. That investment should not be considered in cash equivalents. Then that investment will go to investing activity. I will explain. Wait. So therefore, what is cash equivalent? Short term, highly liquid investment that are readily convertible into cash and which are subject to an insignificant risk of change in value, which is less risk of change in value. For example, investment in equity shares. Suppose you invested in equity shares for 2 months. Is it cash equivalent? Answer is no. Why? Because when you invest in equity shares, your principal is subject to significant risk of change in value. There is no insignificant risk of change in value when you invest in shares, especially equity shares. Of course, preference shares, it will fit into the definition of cash equivalent. But generally, when you consider equity shares, how you say equity shares are cash equivalents? Because in order to call that cash equivalent, that investment should be insignificant risk of change in value. But investment in equity shares, highly significant risk in change in value. Because see, nowadays we are seeing in the stock market, so there is no guarantee. Suppose I invested 1 lakh rupee. So within short span of time, that 1 lakh may become 50,000 or that 1 lakh may become 1,50,000 also. We don't know. So that means the principal is subject to significant risk of change in value. Either appreciation or depreciation, there is a significant risk of change in value. Then that way you should not consider it as cash equivalent. See, when you are saying something as cash equivalent, it is equal to cash, there should be stability. Suppose for example, I am having 100 rupees with me. So that means this 100 rupees currency note, I can exchange anywhere for 100 rupees value. So I can purchase anywhere, I can purchase anything by using this 100 rupees, equivalent to the value of 100 rupees. So there is a stability of value. Similarly, when you are saying something, when investment you are saying is my cash equivalent, the meaning is that it should provide some stability. That investment should have the stability. Suppose if the investment principal itself is in danger, don't consider it as a part of cash equivalent. Sir, can you tell me some examples of these cash equivalents? You said short term, highly liquid, which are readily convertible into cash, which are subject to insignificant risk of change in value. So any example? Yes, treasury bills. See, treasury bills is the best example. Treasury bills. Treasury bills is nothing but the short term securities which is issued by government. If you want, you can invest it. So provided it will fit into the definition, generally it will fit into the definition of cash equivalents because it is short term, 3 months or less, highly liquid. Anytime if I want, I can sell it, and risk almost zero. Short term government bonds, maturity period should be less than or equal to 3 months. Suppose I invested in government bonds for 3 months or less. Generally, government securities, government bonds will have a less risk. So therefore, they will definitely fit into the definition of cash equivalent. Similarly, marketable securities like stocks, bonds, and then money market holdings, options, futures, hedge funds. Of course, options, futures, hedge funds, they are very risky. So if the principal is in danger, don't consider. So if these are very, very risky sometimes, most of the times. So if they are risky, don't consider them. Generally, money market instruments, marketable securities, if they fit into the definition of this, then consider it. So cash equivalents are investments, short term, that means 3 months or less, highly liquid, that they can be sold any point of time, they can convert it into cash, readily convertible into cash, and subject to insignificant risk of change in value. That means the principal should not be in danger. So we discussed the important terms cash and cash equivalents. Now, sir, classification of activities for preparation of cash flow statement. See, every organization, of course, you know to which organization this is applicable. They have to divide the cash activities into 3 categories as per this standard. So various activities of an enterprise resulting into cash flows. See, we are considering only activities resulting into cash flows. That means we should not consider any transaction, any activity which does not involve cash. For example, depreciation does not involve cash. For example, issue of shares for consideration other than cash that does not involve cash. If something is not involved in cash, don't consider it in cash flow statement. Okay. So as per accounting standard 3, various activities of an enterprise that result into cash flows. It can be inflow or receipts and outflow or payment. For example, cash sales, inflow, purchase of fixed asset, outflow, commission received, inflow, salaries paid, outflow, government grant received, inflow, grant refunded, outflow, amount received from debtors, inflow, amount paid to creditors, outflow. So sales promotion expenditure, outflow, advertisement expenditure, outflow, selling and distribution expenses, outflow. So commission received, inflow, dividend received, inflow. So the cash flow means either inflow or outflow. Now various cash activities which are subject matter of cash flow statement as per accounting standard 3, these activities are classified into 3 categories. This is very, very, very important, because when you are preparing cash flow statement, you should remember these activities. So the cash activities, so according to AS3, they have divided into 3 types: operating, investing, financing. Operating, investing, financing. Now, when you are preparing cash flow statement, sir, we need to show separately the cash flows generated by these activities. Each one we need to show separately. Operating activities separately, financing activities separately, investing activities separately, we need to show. And in fact, this cash flow statement format is like that only. I will show you the format also. See, this is the format. See how we are preparing cash flow statement. This is the format. First, we are taking name of the company, then cash flow statement for the year ended. See here, particulars, amount. First, cash flow from operating activities. Second head, cash flow from investing activities. Third, cash flow from financing activities. Then adding these 3, you will get net increase or decrease in cash and cash equivalents. For that, add opening cash and cash equivalents. Then you will get closing cash and cash equivalents. Simple like cash account here. First opening balance, add all receipts minus all payments, then you will get closing balance now. That is what exactly we are doing here. But the thing is that first we will take all inflows minus outflows. These inflows and outflows we are dividing category wise. Operating, inflows minus outflows, one figure will come. Investing activity, inflows minus outflows, one figure will come. Financing activities, all inflows minus all liabilities, one figure will come. These 3 figures if you add, then you will get change during the year. Either there is a net increase or decrease during the year. Suppose for example, total receipts, total payments, total receipts minus total payments. It can be positive or it can be negative. So that is called net increase or decrease of cash and cash equivalents during a particular period. For that we are adding what? Opening cash and cash equivalents. Then you will get closing cash and cash equivalents. Actually, this is how we need to prepare the cash flow statement. Now see here, what is major? Classification. So you should able to understand how these items will be classified. I mean, first cash flow from operating activities. Which items will comes under operating activities? So you should be able to understand. Next, cash flow from investing activities. Which items, which inflows and outflows considered in investing activities, which inflows and outflows considered in financing activities. So that classification is very, very important. Now, listen to me carefully. First, we'll discuss operating activities. Sir, Accounting Standard 3 says operating activities are, these are principal revenue generating activities of the enterprise. What are these, sir? Principal revenue generating activities. What is principal revenue generating activity? See, our organization main objective, why our organization is incorporated, which products, which services we are dealing with predominantly. For example, I am a soap manufacturer. So manufacturing and selling of soap is my principal revenue generating activity. Or suppose, for example, I am providing coaching. So educational coaching. So providing coaching service is my principal revenue generating activity. Suppose, for example, I'm a professional cricketer, a professional athlete. So providing professional services is my principal revenue generating activity. So what is your principal revenue generating activity? What your organization predominantly will do? Relating to that principal revenue generating activity, what are all cash items are there, cash activities are there, they will be considered under operating activity. For example, I am a manufacturer come seller. Suppose if I am a manufacturer, I am manufacturing something. To manufacture something, I need to incur a lot of expenditure. Na? In that expenditure, what are the items which involving cash? All will comes under operating activity. For example, purchase of raw material, operating activity, because it is relating to principal revenue generating activity. And not only that, for example, sales, we are making sales. So sales is what? Principal revenue generating activity. Every organization, commercial organization, is incorporated to sell something or to provide some service. Now, relating to their main service, relating to their main product, what activities it involve in cash, they will consider under operating activity. Principal revenue generating activities. So principal revenue generating activities. And see, one speciality of the operating activity category is it's a residual category. Even the items which is not covered in financing and investing will also come here. So that's why they are saying other activities, other they are saying that are not investing or financing activity. Suppose there is an activity which is not investing, not financing. See, you will understand it only after understanding investing and financing. As of now, don't try to understand it. What is investing, what is financing? First you learn. Then after that, I will tell you again. So residual items. So therefore, according to AS3, the cash activities are divided into three categories. First category is operating activities. Operating activities are principal revenue generating activities of the enterprise, and any other activity that is not investing or financing activity, that is neither investing nor financing, then take it under operating activity. Okay. Sir, can you give me some examples of these operating activities? Of course, principal revenue generating. For example, I can say cash sales. Cash sales is the best example for operating activity because these are principal revenue generating activity, or any cash received from sale of services. Anyway, cash sales. Next, amount collected from debtors. Amount collected from debtors or trade receivables. Sir, any amount you collected from debtors. Debtors, nothing but the person to whom you made credit sales. Now he is making the payment. So whatever the amount collected from debtors is definitely what? It's an operating activity because these are principal revenue generating activities. Similarly, any cash purchases, any purchase of materials you do in cash. So that is also comes under operating activity. Next, amount paid to creditors. Amount paid to creditors. Any, for example, salaries paid, salaries, rent, admin expenses, like selling and distribution expenses, like finance cost, like interest, nothing but finance cost means interest, etc, 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 all kind of operating activities. Of course, see, please understand, If it is fit into the definition of investing and financing, you will take it there. But generally, principal revenue generating activity and any activity, if it is not fitting into the definition of investing and financing, then it comes under operating activity. Okay. So first what we need to do is, as a business enterprise, you need to classify. So the items which involving cash, you need to classify as operating, investing, financing, and later you need to present it. For the purpose of presentation, you should be able to identify first. So that is operating activity. So what is operating activity, sir? What is the organization main principal activity? So relating to that, what are all the expenses you incurred? So that will come here. That will come here. Next, investing activities. See, important. Investing activities these are relating to acquisition and disposal of long-term assets. So acquisition and disposal of long-term assets, important, long-term assets and other investments not included in cash equivalents. That is what I said in the definitions part. See, listen. Investing activities, which items will come? Simple. All asset related transactions like purchase of asset, sale of asset comes in investing activity. Not only that, any investment related activity, purchase of investment, sale of investment comes under investing activity, provided that investment should not comes under cash equivalent. Suppose if that investment is already satisfying the definition of cash equivalent, then don't consider under investing activity. That is what we discussed now. What is cash equivalent? Short term highly liquid investment which can be readily convertible into cash, which is subject to insignificant risk of change in value, like that we discussed now. So that means if any investment, if it is satisfying the definition of cash equivalent, then don't again consider in investing activity. Those investment which is not fit into the definition of cash equivalent, consider here. So that's why they clearly said other investments not included in cash equivalent. For example, in the question they have given money market instruments. So money market instrument is generally a short-term highly liquid investment which is readily convertible into known amounts of cash, which is subject to insignificant risk of change in value, then consider as cash equivalent. Then again, don't consider under investing activity. For example, purchase of equity shares. Company purchase equity shares, investment. But is it fit into the definition of cash equivalent? No. Then consider under investing activity. So whatever the activity you are doing relating to cash, first you need to classify. Either it is operating, investing, financing. Suppose if you want to classify it as investing activity, that investment already should not be classified as cash equivalent. Suppose if that investment is already classified as cash equivalent, then don't consider under investing activity. So purchase and sale of long-term assets. Sir, can you give me some examples here? Yes. For example, purchase of plant and machinery in cash. See, wherever I am telling only cash involved, then only it will come in cash flow statement. Otherwise, no. Suppose purchase of plant and machinery, land and building, furniture and fittings, etc. Because these are all what? Long-term assets. Long-term assets. Okay. So purchase of plant and machinery, land and building, furniture and fittings. Similarly, sale of fixed assets like sale of plant and machinery, sale of land and building, sale of furniture and fittings, all kinds of sales will be covered here. Okay. I have just written some assets, sir. Any other asset, long-term assets, you take here. All transactions relating to assets, purchases and sales, which involve cash, comes here. Not only that, investment. For example, our company invested in shares. Suppose purchase of shares. That means we purchased shares of other company shares. So we purchase of shares. Bonds, purchase of debentures. Okay, etc., etc., etc. All kind of purchases. Investments. If it is not fit into cash equivalent, consider here. Similarly, sale. Suppose when I sell the investment, sale of investments. Sale of investment will also comes under investing activity. Now see, important, when you make investment, from that investment, if you receive any dividend, any interest, that is also investing activity. For example, dividend received, investing activity. Interest received, investing activity. Okay, because that if the particular item is fit into the particular classification, all corresponding related items are also covered under that classification only. So that means, suppose a company purchases shares of other company, that is investing activity. From that shares, that other company declares a dividend, we receive dividend. So that dividend is also investing activity. Suppose a company, purchased bonds, debentures of other entity. Now, from the debentures we receive interest. So that interest is also investing activity. So what comes under investing activity, sir? These are acquisition and disposal of long-term assets. Long-term. Fixed assets. Don't consider current assets. Only long-term assets and other investments not included in cash equivalent. So if they are not included in cash equivalents, then they will come here. Suppose if they included in cash equivalent, don't consider under investing activity. So like this, we have to divide the cash activities into operating, investing. So to put it simply, relating to our main operations, operating activity, relating to our investment, our purchase. See here, investment not only means purchasing securities of outside enterprises or outside entities, but also includes fixed assets. Any purchase and sale of fixed asset will also comes under investing activity. And then last one, financing activity. See, what is financing activity? These are the activity which results in change in the size and composition of owner's capital, including preference share capital. See, all transactions relating to capital, including preference share capital and borrowings of the enterprise. So, if you observe carefully, sir, in Accounting Standard 3, how they have made a classification of cash activities is, first they are saying, see, for which purpose you incorporated as a business and what is your main activities. Relating to that, whatever inflow or outflow, consider under operating. Next in enterprises, what they will do, they will definitely put their money somewhere. They will purchase assets, they will invest in shares, debentures. So that's why they are saying all investing activity one category. The remaining thing is you get money from outside, you issue shares, you issue debentures, you take bank loans, borrowings, nothing but. Now, or you issue shares, capital. So any transaction, any activity that results in change in the size means amount, and composition means mix of owner's capital. Any transaction which is changing the owner's capital, for example, issue of shares. Of course, if issue of shares for consideration other than cash, then they will not come in cash flow statement, because even though it changes the capital, but it does not involve cash. Now we are discussing only cash flow statement. According to cash flow statement, the item should involve cash. It has to be divided into three categories. Last one is financing activity. Financing activities talks about what? Change in the size and composition of owner's capital, including preference share capital. Suppose a company issued preference shares, financing activity. A company issued equity shares, financing activity. Not only that, reverse. For example, a company redeemed preference shares, that is also financing activity. A company buy back equity shares, financing activity. Outflow. Sir, when you issue shares, there is an inflow. When you redeem shares, there is an outflow. Both inflows and outflows under financing activities only. If inflow under financing activity, outflow under investing activity, that will not come. If inflow is one activity, outflow is also comes under that activity. For example, purchase of fixed asset, investing activity, sale of fixed asset, investing activity. Similarly, we have issued shares. So, financing activity. The same shares we redeemed, financing activity. So, any activity that changes the size and composition of owner's capital, including preference share capital. Change in the size means amount, and composition means mix. Owner's capital, including preference share capital, and borrowings of the enterprise. This is important. Sorry, borrowings of the enterprise comes under which activity? Financing activity. For example, a company taken bank loan. Bank loan taken, financing activity. Bank loan given, loan given, investing activity. Taken, financing activity. Borrowings. That loan repaid, financing. For example, a company issued debentures. Sir, debentures is a debt, na? Borrowings. So therefore, financing activity. Debentures issued, financing activity. Debentures redeemed, financing activity. Sir, you purchase debentures of other entity, investing activity. See, when we issue shares, financing. When we invest in other company shares, investing. When we issue debentures, borrowing, financing. When we invest in other company debentures, investing. So there is a difference, Nana. Investing or financing. So financing means what? Borrowings. All borrowings related transactions comes here. Not only that, any transaction which will change the size and composition of owner's capital. So any transaction which will change the size and composition of owner's capital will also comes under this category. So like for example here, I can take issue of equity shares, issue of shares for cash comes under financing activity. Similarly, redemption of preference shares. Suppose preference shareholders, you have taken the money and you are redeeming it. So nothing but transactions relating to capital. So it comes under financing activity. Similarly, for example, we issued debentures. Debentures issued is financing activity. Suppose we purchase debentures of other company, investing activity. Now listen. Dividend declared on own shares, financing activity, because you issued shares, financing. On those shares you paid dividend, financing. Sir, you invested in other company shares, investing. From that shares you received dividend, investing. So dividend paid, always financing activity, because you pay dividend to your shareholders. So when you pay dividend to your shareholders, it is a financing activity, because all transactions relating to capital will come under financing activity. Suppose when you invest in other company shares, that company declares a dividend. That company point of view, that is financing activity. But your point of view, you are receiving dividend on that shares, that is your investing activity. So therefore, there is a slight difference, Nana. Financing activities is nothing but we are getting money from outside. All money we collecting from shares through borrowings and the corresponding items. So inflows and outflows both will be covered under this category. So this is how we classify the items under cash flow statement. Now tell me, according to AS3 cash flow statement, the cash activities are divided into 3 categories: operating, investing, financing. What is operating? These are principal revenue generating activities of the enterprise, and any residual items which is not comes under investing and financing. What is investing activity? So investing activities are purchase and sale of long-term fixed assets and any other investments not classified as cash equivalents. And last one, financing activity. What is financing activity? Financing activities are any activity which will change the size and composition of owner's equity, including preference share capital and borrowings of the enterprise. So first of all, you need to classify all cash items into these 3 categories, because cash flow statement is nothing but presentation of these items. Okay, so till now we discussed here till cash activities we have discussed. So further, next class we are trying to discuss the format of cash flow statement, and we'll try to solve some, we'll try to discuss some important points.